Most people hear the word audit. It doesn't exactly spark joy, but in the world of affordable housing, audits are a key part of keeping things running smoothly, identifying risks early so they can be mitigated, and staying in compliance. Our goal today is to take some of the mystery out of affordable housing audits. We'll walk through why is an audit needed and who are the stakeholders? What comprises an affordable housing audit? What are some key financial indicators that we should be on the lookout for? What are regulatory audits and who requires them? And also some takeaway key insights. We'll keep things straightforward and leave time for questions at the end, but don't be shy about dropping those in the chat or the Q&A along the way. We would like this to be interactive and for you to get the most out of the time we have together. So we'll go ahead and start and jump into making sense of affordable housing audits, and I'll hand it over to Jenna.
Awesome. Thanks, Melissa. And thanks everyone for coming today. We're hoping to give you guys some great insights into what an audit is and why it's needed and how to use it. So we'll just kind of kick off today with some of those key things. And we're going to make sense of an audit, of course. So why is it required and what does it entail and who even cares about the audit? Typically, an audit is required because you have someone giving you some money. So it's typically an investor giving you some equity money or a lender giving you some debt, and that is going to trigger that audit requirement. And those investors or lenders want to see an audit because it gives them some comfort that the financials are accurately reflecting the state of the property. So an audit holds a lot of worth for those investors because it's kind of a third party coming in and saying, yes, this does give a true portrayal of this property and of what's going on. So that's typically why an audit is needed, and how it's being used is just that reliance on a third party kind of comfort level of this is what the property, what you say it is what it is. So those stakeholders, which are typically the investors or lenders, can kind of vary and be a diverse group of people. So an example of some people that might be investing, which is your equity funding, is going to be any partners, if you have tax credits, things like that. This can often be companies, it can be individuals, it can be all sorts of people. And then you're also going to have examples of your lenders, which are giving you that funding in the debt form. Those can also be a wide variety of entities and different things. You might have some things from private sectors like banks. You're also going to have a lot of federal funding, like a HUD loan, an FHA loan, USDA loans, things like that. Then you're going to have other types of government, state and local. You could have home loans, you could have government grants, you could have bonds. So there's kind of an endless list of the stakeholders and who's really interested in these audits. But they do want to see those audits and they want kind of that comfort that the property is what you say it is. So that's kind of the long and short of an affordable housing audit and why it's needed and who's using it. So we'll move on to kind of a high level what the audit entails. Oh, actually, we have our first poll. So hopefully if you're attending today, you want to learn more about reading a financial statement. So right now, how confident are you in your ability to read and interpret financial statements? Very confident, confident, cautious, or not confident at all? We're getting kind of a range here. It's kind of a third, a third, a third almost. Some people are feeling very confident, some are just confident, some are cautious, and we have a few people that are not confident at all. And we're happy you're here today because we're hoping that you're going to increase these confidence levels throughout the course of the presentation. So I think right now, most people are feeling confident, but hopefully we will still teach you something today.
We have a couple more folks to go, so we'll wait a second and then see if we get a few more answers.
It also looks like Ashley is not able to answer, so I don't know if we can convert her back so that she can get some credit.
Yeah, and we can make a note of that, Ashley. I think we're about there, so we can probably end the poll.
All right, so feeling kind of middle confident at this rate, and let's kind of move on and show what else is involved in the audit so we can really get those confidence levels up. So we'll start with the core financial statements. So when you first get an audited financial statement, clearly the focus is going to be those financial statements. So we're going to move across the financial statements that are involved and then also show some supplementary information that might be included. So you're always going to start with your balance sheet. This is really going to highlight your assets, your liabilities, your equity, and we'll go into all this in detail. Then you're going to have your statement of operations. This is also known as an income statement or profit and loss P&L statement. This is going to show your revenue, expenses, your income or loss. Then you have your statement of cash flows. This is really showing your use of cash, what are you using cash for, and how are you getting your cash. Then you have your statement of owner's equity. We talked about your people giving you equity are typically going to be a stakeholder. So this is going to show who those people are, their contributions, distributions, allocation of income, things like that. And then finally, the last core element of your financials is your footnotes. The footnotes is going to be where all your words are at. A lot of people think audit is all about numbers, but the footnotes actually really paint a story and really give you some details on what's really included on those financial statements and kind of paint a picture outside of just the numbers. So that's a really important part of the audit. And then finally, some audits are going to require additional information, which we often require or call supplementary information. The supplementary information is some examples of common things are a schedule of operating expenses. This is just going to detail those operating expenses and, break it out with some more detail behind it. Some audits might require an internal control report, which is going to tell you if your internal controls are sufficient, if they're working as intended. They will highlight any issues if those are found. If you have a HUD audit, we mentioned HUD funding being a big part of affordable housing. Those are going to require HUD compliance reports that are really telling HUD, are you doing what you're supposed to do? Are you following HUD's rules? And if not, kind of where are the areas where you could have some improvement. And then the findings really talk about if you do have internal control problems or you do have issues with your HUD compliance, the findings are really going to delve into that and give you the detail behind it. And more importantly, also talk about how you can improve in those areas. So those are our core financial statements and our supplementary information that make up an audit. And we're going to go into detail on all of those throughout the presentation. So I think I'm going to pass it back to Melissa to cover the balance sheet.
Yes, so now we will kick off talking about the details of the financial statements by discussing the balance sheet. This is a snapshot of the project's financial health at a single point in time. So think of it as a picture of what it owns, what it owes, and then what's left over. So the breakdown of the balance sheet are the assets, which is what the project owns. And then there are the liabilities, which is what the project owes. Those can be loans, unpaid bills, and other obligations. And then we have the members or partners' equity, which is what is left over after you subtract what you owe from what you own. So the balance sheet follows a simple formula of assets equals liabilities plus members' equity. So it's called a balance sheet because both sides of that equation have to match. Everything has to stay in balance. So you'll always see in your balance sheet that the total assets must equal the total liabilities plus owner's equity. So let's go over this example of a balance sheet. We'll start off with the assets. Typically, the balance sheet is organized on the asset side from the most liquid asset. So for example, cash is cash, and then it goes to what else can be converted to cash quickly. So those are typically your current assets. What I look for here is the cash, your cash balance. How much is your cash balance? Did it change significantly year over year? Then I also like to look at tenant accounts receivable and any related allowance for doubtful accounts. That shows amounts that the tenants are unlikely to pay, and this could indicate issues with collections, with rent collections. You also have your restricted deposits and funded reserves. So typically those are your tenant security deposits that you hold, and then also any restricted reserves that are required by HUD or a lender or the limited partner. So those are not as easily accessed by the project. Next are the fixed assets. So includes the cost to construct the project, the land and improvements, less your accumulated depreciation. The other side of the balance sheet includes your liabilities and members' equity. So typically, this is organized with the liabilities that are due the soonest at the top. So typically, your current liabilities would be due within 1 year of your balance sheet date. And then you'll have your long-term liabilities and then any deposits. So your current liabilities are typically made up of accounts payable, which are amounts owed to vendors, amounts owed for payroll, management fees, utilities, also accrued interest on your debt that's due within 1 year, and then any current maturities of your debt that's due within 1 year. The next section is your deposits and your prepaid liabilities. So this shows your tenant security deposit, which is the money that's owed back to your tenants when they move out, and this is required to be kept in a separate account. When I look at a balance sheet, I always look to make sure that this tenant security deposit liability is less than the security deposit cash. So this ensures that the project has kept enough cash aside in their security deposit cash account to cover those liabilities. The next section I look at are the long-term liabilities. So this is typically your debt, your large long-term loans from banks, state agencies, HUD, and then it can also include some other items such as your deferred developer fee. The next section is the members' equity. And so this might also be shown as partners' capital. And so we'll discuss what's comprised in equity when we discuss the statement of owner's equity. When I look at a balance sheet, some of the red flags or discussion points I look for are the current ratio. So that is if the current assets are less than the current liabilities. So you take your current assets, divide it by your liabilities, and that shows that you do not have enough current assets to pay for those current liabilities, which could indicate a liquidity or a cash flow issue for the project. Also, as I noted, any large receivables or allowances that could indicate a collection issue. Looking at the reserves, are they a good amount that can sustain any property maintenance in the long term? Is there an operating reserve that could cover any of those losses that are in the short term? So how are those reserves funded? I also look to see if there's any debt coming due. So in the current liability section, you might have a loan that's coming due in the next year. So understanding how the property is planning to refinance that loan or if they're going to pay it off. So those are questions I would ask and things I would look out for when reviewing a balance sheet. Next, we're going to have another polling question. So on the balance sheets typically include, and you can include all that apply. So you can check multiple. So assets, liabilities, equity, revenue.
And Melissa, after the poll, we do have some questions. So Jill asked if there is a rule of thumb for a healthy ratio. And we might have covered that when we talked about the current ratio, but I don't know if you wanted to speak more to that.
So you want your current ratio to be over 1 for sure. So that means that your cash, your receivables exceed your liabilities, but I would probably look for something over 1.5 or 2 just to ensure that you have that cushion there for the property in case there are unknown expenses that are coming up. You also have your reserves to cover those, but most projects don't want to dip into their reserves unless it's absolutely necessary. And these are good things. If you're reading the financial statements, you can ask the general partner about, and then they may have some reasoning. For example, I'll go back. I think I can go back to this slide. So this shows the balance sheet we were discussing. And a significant portion you'll see of the current liabilities is this due to affiliate, which are their asset management fees, partnership management fees, things like that that have accrued. Most likely, the general partner and the limited partner are not going to be required, are not going to make the project pay those if there's not sufficient cash. So you can also reduce that by any related party fees that maybe don't actually need to be paid, like the asset management fee, a related party management fee, or due to affiliate. All right, so I think almost everybody got this correct, so that's awesome. And I think we can close the poll. All right, next we will discuss the statement of operations, and Jenna will take that one.
Awesome. All right. So statement of operations, as I mentioned earlier, this can also be called an income statement, profit and loss, P&L. So you'll hear a lot of names, but typically statement of operations is what we see in the affordable housing industry. So this is going to talk about your revenue and your expenses. So first we'll cover our revenue. So our typical revenue sources, of course, is going to be our rent. And we're going to start with that gross rent potential, our GRP. This is going to be our market rents less our vacancies and concessions to arrive at our net rental revenue. Next, we're going to show our tenant charges. This is typically amounts that are being paid by the tenants that aren't related to rent. So usually like a pet fee, a late fee, laundry income, parking income, things like that. It's going to be pretty insignificant when compared to our rent revenue. Our rent revenue is really the focus. And then we can also sometimes see our rental subsidies. If you have a rental subsidy, it will be shown here as well. So those rental subsidies are typically Section 8 or some kind of other state or local subsidy for housing that your tenants are receiving based on their income status. So that's going to be our typical revenue sources. And now we'll move on to our expenses. So our expenses is kind of divided into two areas. You're going to have your operating expenses, which is really the focus of, this is what it takes to run the property. And are we able to pay all these expenses with our revenues? So you have your property management fees, your payroll, your repairs and maintenance, your real estate tax, your insurance, and your utilities. Those are probably the most common operating expenses. And then we have our other expenses. The other expenses are typically things that are not a part of operations. Some people will call these like below the line. Some of these are also considered non-cash. So you're always going to have your interest down there. This can be the interest that you're paying on your debt or interest that you're paying on any related party fees. It can also be interest income that you might be earning on your escrows. Then you're going to have your depreciation and amortization. These are often referred to as non-cash, as it's just kind of a gap figure for your assets that you're having to depreciate over their lives. Oftentimes, you'll also see related party fees here. Many of these related party fees can be kind of, I guess, stipulated upon meeting certain ratios. So you might only pay asset management fees if you have a certain occupancy rate met or things like that. Or if you need to generate a certain amount of cash before you're going to pay these kind of fees. So those are typically included down at the bottom. And then other entity expenses, oftentimes these can be one-time events that are not expected to be reoccurring. You might see insurance claims here. So that could be income from insurance claims. It could be, losses from insurance claims. You might see some other items here that are one-time, like if you had a lawsuit settlement or something like that. Those are typically going to be included with those other entity expenses. So that's kind of your two expense items. And then we'll move on to show a visual of your statement of operations and kind of walk through what that looks like. So we started with that revenue at the top with our rental income and showing our vacancies. The big thing you really want to look at here is what is your vacancy rate. So you're going to calculate that by dividing your vacancies by your rental income and seeing what the percentage is. So this one is coming out to about 10% a year. You do want to focus on that vacancy rate, and I think 10% is probably something that you want to see 10% or less. So I think we're going to go into vacancies a little more later on and talk about some averages across the nation, averages across affordable housing. But that is something you want to look at is those vacancy rates and also just year over year comparisons. If you do have a comparative statement, we can see that our rent revenues went up this year. So there was probably some kind of increase in our market rates. So that's something to always note as well to look there. Then we'll move on. You have your operating expenses or our tenant charges, like we discussed, which are those other sources of income from tenants that aren't rent. right there. And then we have our operating expenses, which is kind of the common things that it takes to run the property. And then most importantly, is your revenues minus your operating expenses generating income. So you do want to see income from operations. That's a big sign if the property is performing well, if it has good performance, it should have income from operations. If you have a negative number here, that's a bit of a red flag and there's probably something going on, or the property might be newer and still kind of getting off its feet. So that's our items to look for there. And then again, you just have your other income, which you can see here is the interest income, that interest expense. You have some asset management fees, depreciation and amortization. Those really are kind of below the line and something that many stakeholders aren't super focused on when they're looking at the income statement. The focus is really going to be on that income from operations. Before I guess we move on, I do think we had some questions in the chat, and these might go back to the balance sheet. So I don't know if Melissa, you want to take that one?
Yes, I can take that one. So I see are required deposits to reserve accounts considered an expense? If not, why? So they are not considered an expense. They are considered an addition to your balance sheet. So it is cash that is going out the door of the partnership, but it's being placed in a reserve. So you still technically have that as an asset. It's not an expense that was paid to another entity. So it's not on the statement of income, statement of loss, or statement of operations. Anything that is withdrawn from that reserve that's used to pay expenses, those expenses would be included on the statement of operations. But technically, they wouldn't be a deduction in operating cash because they were paid through the reserves. So sometimes projects will have cash flow budgets. And in the cash flow budgets, rather than being on a GAAP basis of your statement of operations, you'll show that deposits, the deposits are coming out of your cash flow. And it is different for a housing authority. So those are different on GASB, whereas an affordable housing audit is typically on FASB, which is the Financial Accounting Standards Board. So there's a little difference between a governmental entity and then these are considered a limited partnership, a private entity.
Awesome. Yeah. So all the presentations that we're showing today are a typical audit, which is under the FASB, which is US GAAP. That's just going to be for most non-public corporations are going to require that presentation. Any non-public entities. It looks like Jeff mentioned that for a housing authority, he sees something different, and housing authorities are subject to government audits, which is going to be a little bit different. So that is the difference there. All right, and I think I'm now passing it back to Melissa to go in depth on the statement of owner's equity.
Yes, so we will talk about the statement of owner's equity. So the typical equity structure, ownership structure in an affordable housing project is often set up as a partnership or limited liability company with two main players, a limited partner or investor, and a general partner or managing member. So the limited partner contributes most of the equity to construct the project, and they often have around 99% ownership. The general partner holds a smaller ownership interest, typically around 0.01% to 1%, but they are responsible for the day-to-day operations. The net income or loss that's generated by the project is allocated to each partner based on their ownership percentage. So what comprises equity for each partner? The first component are the contributions. So contributions increase equity. This is money that's provided to the project, typically to construct the project for initial lease up and to fund the initial reserves. The majority of contributions are typically made by the investor member or the limited partner. The next component are distributions. So distributions decrease equity. This is money that the project pays out to the partners. Typically, it's paid out of cash flow earned by the project, and there are stipulations on how much and how and the time periods where it can be paid out to each partner. The last component of equity is the net income or losses from that year, and that will create retained earnings. So retained earnings are the income or losses that have accumulated by each partner based on their ownership percentage. So next, we'll look at an example of a statement of owner's equity. So this is a typical statement of owner's equity. Sometimes you will have more limited partners. You might have a federal tax credit partner, a state tax credit partner, and then a special limited partner. So there could be multiple, but typically it shows the ownership percentages either in a footnote or in the statement of owner's equity. So you can see the ownership percentage for each entity. And you can think of this as a running tally of the partner's stake in the project over time. It shows how much money the owners have invested in the property, how much the property has earned or lost, and how much has been taken out by the owners. Kind of like a bank account for ownership. Money goes in, earnings or losses change the balance, and then withdrawals reduce it. So typically what I look for in the statement of owner's equity is to look at the limited partners balances. Typically those should be shown as positive, which shows that their contributions that they've made from inception exceed the losses that they've taken cumulatively. And then next, I will hand it to Jenna for the cash flow, which is usually everyone's favorite statement.
Awesome. So the statement of cash flows, I think, is probably one of the most I guess, confusing statement and not as understood. And it definitely has its reputation in the accounting world as being difficult to come up with. But this is really the most important statement, in my opinion, especially for the stakeholders and for owners and people that really want to dig in and see how the property is doing. The statement of cash flows, if you had 5 seconds to look at a financial statement, this is where I would go to see what's going on and how the property is doing. So we've talked about that cash flow statement is really going to talk about the cash coming in and the cash going out and what it kind of means. So first off, you want to see, is this property able to generate cash or is it not able to generate cash? That's kind of like bottom line, is this doing well or not doing well? And we'll kind of look at an example, but that generating the cash flow, you really want to look at that from the operating activities, the day to day, what's going on. Are you able to generate cash flow? If you're not, that's often a red flag. Then we're also going to go over are you able to meet your obligations? Are you paying distributions to those owners? Or do you need additional financing? Have you had to take on more debt? Have you had to get some capital calls and have the owners put some money in the form of contributions? So the cash flow is really going to show all of you this in a quick glance. And even though it's a little confusing, we'll try to break it down for you guys. And there's also, to add to it, multiple ways you can present a cash flow. So you can have two different types of cash flow statements, a direct or indirect, and both are accepted in the GAAP financial world. But HUD does require a direct statement. So a lot of times you guys are probably used to seeing the indirect statement, which is going to start with your net income and then show cash from operating, cash from investing, cash from financing. And that indirect method is really looking at your balance sheet fluctuations to kind of paint the picture. So if your assets are increasing year over year, that typically means that you have a cash outflow. So if your building and improvements have increased by 100,000 from the prior year, that's a cash outflow because you've spent some money to increase your assets. If your liabilities have increased year over year, that's going to show a cash inflow. So if your debt was $1 million last year and it's $2 million this year, that means you had a cash inflow of $1 million. So that indirect method is really looking at those fluctuations between your balance sheet accounts to kind of paint that picture of cash coming in or cash leaving your property. To further complicate things, the direct method, which is required by HUD and also some government entities that people have alluded to, it's going to look at your income statement, your statement of operations, and your revenue and expenses and kind of analyze the variances in those to kind of tell the cash coming in and cash going out. So it's going to say you've had cash coming in of 2 million in the form of rental income, and you've had cash going out, usually by the operating expenses. You've paid this much in property management fees, you've paid this much in insurance, you've paid this much in taxes. So it's going to kind of paint the picture in that kind of light based on your revenues and expenses. And that's all just to get to that cash from your operations, which is the most important figure in the cash flow and really the most important figure in the performance of the property. Um, Also, in addition to operating activities, you're going to see your investing and financing. So the investing activities, which we're back to that indirect method, are all going to be focused on your long-term assets. So for affordable housing, you're usually looking at your building and improvements, your fixed assets here. Are you, increasing those by spending money to make your asset better. And then your financing activities is going to be your long-term debt and your equity. So this is where you're going to see your loan proceeds, your payments on your loan, your contributions from your owners, or your distributions to your owners. So we'll go ahead and move forward to a visual representation of what we just talked through. This is an indirect cash flow for all those cash flow experts out there. So we are going to show that operating activities, investing, and financing, and we're going to analyze this based on our changes in our balance sheet accounts. So you can see our tenant accounts receivable must have increased year over year because that's showing as a cash outflow. And then we'll look at a payable. So it looks like our accrued expenses went up a little bit. It was an increase in cash, so that means our accrued expenses are more this year than they were last year. Then, most importantly, that net cash provided by operating activities. This is the main thing. If you were going to open an audit and close it 5 seconds later, I would come here and see if you have that positive cash. So that's something you really want to focus on. This example, we do have positive cash, so we're doing great. The property is able to fund itself. Its day-to-day operations are funded by the money it's bringing in. So that's a great thing. Then we'll also have that investing activity, which is really going to show if you're doing improvements, if you're, getting new furniture, doing a rehab, or if you've had an insurance claim, you're going to see some additions to the property there, things like that. And then your financing activities is going to talk about your loans and your equity. So overall, when you take those three things together, your operating activities, investing activities, and financing activities, you're going to come up with a total number if your cash has increased or decreased from the prior year. So that's really showing what has gone on with the property. This one had a slight increase year over year. And then another thing I wanted to mention is this is including your cash and your restricted cash. So a lot of times people might think this is just your operations, but this also does include your restricted cash, which might be those escrow balances and reserves that we talked about earlier. So that's your cash flow statement. It is a requirement for all GAAP audits. It can be confusing, but it does really paint the picture of what happened at the property during the year. All right, so that's kind of the summary of all of the financial statements that are typically included in an audit. I do see a Q&A. Okay, maybe that was old. And now we're going to move into the footnotes, which is really that qualitative part of the audit, and it's going to be really descriptive. So I'll pass it back to Melissa for that.
The notes to the financial statements, once you've gotten through that cash flow, you're probably ready to close the audit, but there's still more to go. It includes the notes to the financial statements. They're often overlooked, but they're incredibly important, like Jenna said. The notes are kind of the behind the scenes details that help you understand what's really going on in the numbers. Also, it can show things that aren't reflected in the numbers, which are really important, any risks that the property has. So if the financial statements are the what, the notes are the why and how. They explain the property's finances, who's involved, what the funding looks like, and then any rules or risks the property is working under. So they can explain what accounting rules were followed, how any specific numbers were calculated, and then any unique agreements or risks related to the project. In affordable housing, typically you start with the organization, so information about the organization. It'll have a description of the project, the type of housing it is, the key parties involved, and the ownership structure. So that's very important. And then you'll have a summary of significant accounting policies. So that shows the accounting rules that were followed. And it can be a pretty long list. You can have that it's under GAAP. It can talk about revenue recognition for rent, how that's recorded. But there are a few that I think are important to browse over and make sure that there's not something important there that you need to highlight. So one of those footnotes is impairment. So an impairment would be booked if there's a triggering event. So if something happens at the project that could cause the fair value of the building to be less than the amount that it was purchased for, less the accumulated depreciation, which is your carrying cost. So if you had $10 million net building on your balance sheet and something happens at the property and it looks like now it's only worth 8 million, you might have to take a loss of that $2 million as an impairment loss, which would go in that other expenses that Jenna talked about. So typically I just kind of look at that last sentence in the impairment footnote that says no impairment was taken during the year. And if there is something, then it would be something to look into. It could indicate an issue with the future cash flows and operations of the property. The next I would look for is something called a going concern. It might be called company conditions. It's included if there are factors that would indicate the project may not be able to continue operations for the next 12 months without additional support from the general partner or from obtaining new financing. So this is really important to look out for. Typically, this would include the reasoning. So the reason that the going concern is there, if there's sustained negative operating cash flow and the general partner has had to fund the project, if a loan is coming due within 1 year and the property doesn't have cash to pay the loan, and they also are not able to refinance or get a new loan to cover that, that could also be an issue. So I always look out for those two footnotes. Impairment is always included in significant accounting policies. Sometimes going concern is, and sometimes it's also a standalone footnote. Another one I look out for is the concentration of credit risk. So this shows the amount of cash that the project is holding that exceeds the FDIC limit of $250,000 per entity at each bank. So this kind of shows your cash at risk if the bank were to fail. So typically, we like to see that number not being too high, and sometimes projects and management companies and owners will diversify their cash into multiple banks to ensure that there's not that concentration of credit risk. Also, subsequent events, you might see this in your significant accounting policies, or it could be included as a standalone statement or standalone footnote. So this would show anything important that would be important to the reader to understand the state of the property as of the report date. So this is anything that happens if you have an audit that's as of December 31st and the final is issued March 31st. In those 3 months, did anything occur that would be important to the reader? So examples of that would be new debt that was taken out, a lawsuit settlement, a natural disaster or a fire at the project, something of that nature, changes of ownership. So that's really important to check those subsequent events because those would not be in your core financial statements. Those don't show up as a number. So it's only shown up as that written word that you need to read. Next are some standalone footnotes that I like to look at. So the first probably that I would look at is, if you only could look at a few, would be the commitments and contingencies. So those are any outstanding commitments that the project have that may or may not be on the balance sheet, and then also any contingencies. So this could be an outstanding lawsuit that is unable, we don't know what the outcome will be, we don't know what the amount will be. There could be a range, so it could maybe be a liability to the project, a possible liability that's not recorded on the balance sheet. So that's really important to look out for items like that. It could also be insurance claims or other risks to the property. There's also the debt footnote, which includes who are your lenders, what are the interest rates, and especially when does that debt mature. So there's always the 5-year debt maturity. So it shows everything that matures in the next 5 years. And if you're in 2024 and you see something's maturing in 2026, although that's not current now, it's probably something to look forward to make sure that that would be able to be covered. Also, the related party footnotes. So a related party is any entity that the project does business with that is owned or controlled by one of the owners of the project. So typically there are related party fees in these projects, so asset management fees, partnership management fees, incentive management fees. So those would be detailed there. There are also developer fees, and then the related possible deferred developer fee liability. And then any related party advances, loans, or repayments. Also, the property manager can be a related party. So your property management fee footnote might also be included in your related party footnote. And that details out your expense related to the project management. And it also might detail out any other expenses that are paid through the property management company on behalf of the partnership. So they probably have the employees, they're probably the management company's employees, but the project is paying the management company for those employees. So items like that would be detailed. There's also generally a long description of the distribution of cash flow waterfall that's directly from the partnership or operating agreement. And that this shows that if there is any cash, the order in which it is to be distributed. So that's always interesting to see as well. So next, we'll talk about some key financial statement indicators. So Jenna will walk you through those.
Awesome. So we've been through the financial statements, we've been through those footnotes, we've kind of highlighted throughout some things to look out for, but now we'll go over that in depth, what you should really be looking for when you're looking at these financial statements and footnotes. I also kind of call these like the read between the lines. You may not be able to see this directly on the statements or directly in the footnotes, but you can use the information there to come up with these performance indicators and really give yourself that boost of how things are going. So the first one we'll talk about is the debt service coverage ratio. So this is a ratio that's really going to tell you if you are able to pay your current debt obligations. This is calculated by taking your net operating income divided by your debt service. Your debt service is just simply your payments that year of interest and principal. So typically you want this number to be higher than one. Um, a lot of times certain lenders will require you to have a certain debt service coverage ratio. They might have it 1.5, 2, somewhere in there, but from your sake and for the property's health sake, you want to make sure this is one or higher. Anything below one means that there might be debts or liabilities coming due that you're not able to pay. So you can take the numbers on your financial statements to calculate this. Next, we've talked a lot about vacancy rates and occupancy rates. When you're looking here, you really want to look at, how is the project performing based on your expectation? So typically, just broadly, we're looking at occupancy rates. We want those to be higher than 90%, which means your vacancy rates are 10% or less. But based on your own property, you might have different expectations. If this is coming out of construction, obviously those numbers are going to look a lot different. If you've recently increased your rental rates, those numbers might be affected. I looked up some averages, and it does look like nationally affordable housing is settling at about 3% vacancy rates, and rental housing in general is at about 7%. So that can kind of give you an idea of how your property is performing. And just keep in mind, if you have something way outside of that 10% boundary, you probably have an issue, and you might have a management issue, or you might have a project specific issue. Like maybe you have some units down, you're doing some rehab, or you need a new manager, something isn't going right. So that's something to really look for there. And again, you won't see those numbers displayed directly on the financials, but they're very easy to calculate, and that's something you should be looking at. We've also talked about reserve levels. This is really your escrows. Oftentimes, your partnership agreement or your loan agreement or both might require that you set funds aside to ensure that the property has enough to make their annual tax payments, their annual insurance payments. They might have a replacement reserve or an operating reserve to cover, damages to the property or things coming up to make sure there's money set aside to handle those issues. So that is something you want to look at. You can ask for an escrow analysis from your auditor, and they'll be happy to give you that. You can also just look at that yourself. If you know your upcoming property taxes are 500,000, what does your escrow look like? Do you have enough? The reserve levels were really a hot topic in the last couple of years, as I'm sure many people on this call have seen that the insurance policy amounts have just increased exponentially, and a lot of times people were having to pay more for insurance than what they had reserved for. So that might mean that members had to put money in, or different things kind of had to come about to make sure people could make those payments. So that was the reserve levels. That's really important and something that should definitely be paid attention to. I also just saw Michelle asked if we will be sending a recording of this training, and We are recording it, so I'll inquire and see if we can share that with everyone or not. You should also have a copy of the slides as well. If they weren't sent, we will send them by the end. All right, so to continue on those key performance indicators, we have a couple more that are important that we wanted to highlight. The current ratio we talked about when we looked at the balance sheet, but this is looking at your current assets and your current liabilities to make sure that your assets exceed your liabilities. Again, you want this ratio to be 1 or above. So 1 is an easy number to remember for your debt service and your current ratio. That's something you want to look at. If it's below 1, you might have some problems and you might need some additional funding to be able to meet your obligations. So that was your current ratio. Again, it's just your current assets and your current liabilities and making sure that your assets are greater. Accounts receivable, we have hit on this a little bit. Accounts receivable are your tenant receivables that, people that rents have come due and they haven't paid it yet. So typically in affordable housing, we want this number to be pretty small. You are hoping that most of your tenants are paying on time or early. And if you have tenants that are 30 days past due, 60 days past due, 90 days past due, that's usually not a great sign. And the likelihood of collecting those can be relatively low unless it's coming from some of those government subsidies. So you definitely want that accounts receivable as a percentage of your total revenue to be pretty small. Another thing you can look at is your accounts receivable, the days outstanding. So you would calculate that by really looking at your accounts receivable divided by your revenue times 365 to see how many days are outstanding. And I would say you really want that to be 30 days or less because, again, oftentimes if you have tenants that are non-paying, usually that's going to result in an eviction and that money is not going to be collectible. So that's something else to look at on your balance sheet and your accounts receivable. You want those numbers to be relatively low. We've also talked about vacancies a good bit, but we have not talked about bad debts. So the bad debt kind of comes in, like we said, when you have those accounts receivable and they're not able to be collected, you're going to write those off as bad debt. So you do want your bad debt to be, I would say, less than 1% of your total revenue. You don't want those numbers to get very high. So that's something to look at. And again, the vacancies, you probably want to be less than 10% of your total revenue. So those are some important ratios that you may not see on the face of the financials or the face of the footnotes, but are easy to kind of calculate yourself and just give, a good idea of how the property is doing and something that is going to give you a boost when you're reading those financials to help you understand things a little bit better.
So next we have our third poll. The current ratio informs you if, so you'll pick one of these answers, the assets are sufficient to cover the liabilities, tenants are making timely rent payments, or debt payments are current. We'll give a little bit more time to answer. And a lot of these ratios or percentages are things that we actually look at as auditors when we're doing the audit, and they can create questions when we're doing the audit. So we might ask the management company or the owner, what is causing this significant AR, or are the tenants being evicted? Do you think it's collectible? Or what's the reason for the high vacancies? So that we can understand in our audit kind of the reasoning behind these as well. And we need to know the story of the project. So it looks like we just need a couple more answers. We'll close in a second. Okay, it looks like almost everyone got this one right. Assets are sufficient to cover current liabilities is the answer. And I think we can end the poll. So over 90% got that one correct, which is great. So next we'll move on. I know we had a question about the auditor's reports, and so we'll go over what those are and then regulatory audits. So what is the auditor's report? It's also known as the independent auditor's opinion. This is the auditor's official letter that goes in the front of the financial statements. It answers one big question. Do these financial statements give a fair and accurate picture of the organization's finances? So there's a few types of opinions that the project can receive. They can get a clean opinion, which is called an unmodified opinion, which is great news. It means that the numbers are reliable and follow the accounting terms. And then there also could be terms like qualified, adverse, or disclaimer, which are rare when things are running smoothly. So the auditor's report is kind of a seal of approval, and a clean opinion means the financial statements can be trusted by those lenders, investors, and regulators. If you have a regulatory audit, you might also have an auditor's report over internal control or over financial reporting, and then an independent auditor's report on compliance. So the report on control shows kind of what is behind the scenes. Um, so for both the compliance and the internal controls, is the organization following the rules and regulations of certain agencies? Do they have controls in place to catch mistakes, noncompliance, or fraud? And is it handling federal or state funds properly? So basically, these reports kind of show is the project playing by the rules? So next, we'll talk about regulatory audits. So what can cause a regulatory audit? It can be required by HUD, RD, or a state agency. And if you do have a finding, you'll notice you'll have a schedule of findings and question cost. So this details out that compliance. So if the auditor finds noncompliance, it will be called a finding. So they'll detail out any question costs. So if any funds were paid in excess of amounts allowed by HUD to a related party, especially, or if there were payments to other properties, those amounts would be quantified. It also includes the cause of the finding or noncompliance. So how was this able to happen? Generally, it's a lack of internal controls or that internal controls were overridden. It also includes the recommendations from the auditor. So this is what the auditor recommends the client do to remedy the finding. And then also it includes the view of responsible official, which is the response from management. So this is management's response to the agency of how that issue is being fixed and what controls are being put in place to prevent it from happening again. So this is a really important part of a regulated audit, especially in affordable housing, because investors, agencies like HUD, USDA Rural Development, state housing finance authorities really care about compliance, and it's more than just the numbers. It's also the internal controls and the compliance with regulations that they're looking for. And then lastly, we will talk about some takeaway key insights, go over some things that we've discussed previously, and a little bit summarize the presentation.
Awesome. So we're in our last couple of minutes here, and we appreciate everyone coming today. We hope that you were able to learn a little bit more about an audit, why it's important, and what you should gain from it. So hopefully you've seen that the audit is more than just a number, and it really does provide a lot of information for your financial statement users. We went over those financial statements like the balance sheet, the statement of operations, the statement of cash flows, and the footnotes, and kind of what each of those tells you. We also talked about, if you want to move up a slide, Melissa. We also talked about those things that you can read between the lines and kind of come up with these ratios to give you a better picture of how the company is doing. So we talked about the current ratio, the debt service ratio. We talked about, do you have net operating income? Do you have cash flow from operations? Is that positive? What are your occupancy rates? What are your vacancy rates? What does bad debt look like? Those are all things that we suggest you guys really focus on when you're reading the financial statements. And then we touched quickly on the compliance with your regulatory agreements or internal controls and what that could mean if you do have findings or issues noted there. And then kind of circling back to what we started this all off with is why do you need the audit and who's using it? So that's kind of your quick list there of who is interested in your audit and who's kind of the ones really digging into these. Hopefully many of you on this call are included in that group. But that is kind of our users of the audit and who's looking at those. So do you want to move on? Because we do have one last poll question and want to give you guys your credit. So just a reminder that you need to answer 3 of 4. So after the course, how confident are you feeling in your ability to read those financials? Hopefully we see a lot of very confident, and this really helped you guys. We will also have these slides available and possibly the recording so that everyone can come back to this. I know we did have some people that were cautious or not confident before, and I'm not seeing any of those responses now, so that's awesome. We're also going to give you guys a couple more minutes to answer the poll or a couple more seconds, but we'll also share our contact information, and we're also happy to answer any questions or, if you guys have in-depth things or just want to learn more about an audit, we're happy to help you and be a resource for you guys. So we are with Aprio, who's a big part of affordable housing, and we've both been doing this for a while and just want to help everyone be able to really understand the audit and how important it is and not cringe when you hear the word audit. So
Yes.
we'll close the poll in just a second and I'll pass it off to Melissa to see if anyone else has any more questions or if she wants to wrap it up. And also, please refer to the chat and evaluate our training. Just fill out this quick survey on how things went and how it learned. That always helps us do better. We appreciate the opportunity to be here and we want each of our presentations to get better and better.
Yes, I echo what Jenna said. Thank you so much for taking the time today. We really appreciate it, and I hope you got a lot out of our presentation. You will also get your CPE certificates by email if that's something that you need. And yeah, if you have any questions, let us know. We're happy to stay on for a couple minutes if you have any questions you'd like to go over in the chat. And yeah, thank you so much. I think that's all.
Thanks, everyone. Have a great day. And if you can't see it in the chat, we will work to distribute the materials and recording. And thanks again.